Friday, March 10, 2023. Inside a quiet federal office building a few blocks from the White House, the phones do not ring loudly. They vibrate. Low, controlled, purposeful. Outside, the city moves as it always does, traffic lights blinking, footsteps echoing on concrete, news tickers scrolling markets that are already closed for the weekend. But inside, time has narrowed. A regional bank one few Americans had thought about a week earlier has crossed a legal line. Its balance sheet no longer works. Assets no longer cover liabilities. Capital is gone. And with that moment, a machinery designed long ago begins to turn. Not a bailout. A resolution. For decades, Americans were taught a simple story about banking crises. When banks fail, the government steps in. Depositors are protected. Taxpayers absorb the cost. The system moves on. That story ended in 2008. What replaced it was quieter, more technical. Buried in legislation, regulatory handbooks, and legal definitions most people never read. A framework designed not to save banks, but to liquidate them without public outrage. And at the center of that framework lies a paradox few depositors understand. Your money in the bank is not legally your money. It is the bank's liability, a promise. And in a failure, promises are negotiable. This documentary is not about fear. It is about process, about law, about what happens not hypothetically, but procedurally when a U.S. bank fails in the modern era. Because since the financial crisis of 2008, the rules of failure have changed. The architects of those rules believed bailouts were politically impossible to repeat. They believed taxpayers would not tolerate another rescue of private balance sheets. And so they designed a different solution. Losses would be absorbed internally, by shareholders first, then bondholders, and if necessary, by depositors whose funds exceed insurance limits. This mechanism has a name, the bail-in. But in the United States, it rarely appears under that label. Instead, it hides behind bureaucratic language. Orderly liquidation, resolution authority, bridge banks, claims hierarchy. Terms that sound administrative, until they aren't. To understand how deposits can be converted into equity, you must first understand how banks actually function not as vaults of money, but as leveraged balance sheets. Every dollar deposited becomes fuel. It is lent, rehypothecated, pledged. On paper, it becomes an unsecured claim against the institution itself. And when that institution fails, claims compete. This is not speculation. It is codified law. After 2008, Congress passed the Dodd-Frank Act, granting the FDIC extraordinary authority to resolve failed banks in a way that preserves systemic stability even if it means rewriting ownership overnight. The goal was simple. Never again allow taxpayers to absorb private banking losses. The consequence was more complex. For the first time in modern U.S. history, large depositors were explicitly placed inside the loss absorption stack. Not rhetorically, legally. The inspiration did not come from theory. It came from crisis. In 2013, on the island nation of Cyprus, depositors woke up to find their accounts frozen. Within days, balances above insured limits were partially seized and converted into bank shares. Shares in institutions that no longer functioned. The world called it unthinkable. Regulators called it a success. That event became a template, not copied verbatim, but studied carefully. Because what Cyprus demonstrated was something policymakers had long suspected. Depositor funds could stabilize a failed bank without public money if the law allowed it. In the United States, the law already does. But the system is designed to operate quietly. Over a weekend, with press releases timed carefully, with assurances repeated often. Depositors will have access to funds Monday morning. That sentence has become the signature of modern resolution, but it conceals a deeper truth. Access is not the same as ownership. As we move through this documentary, we will follow the path of a failing bank from balance sheet stress to regulatory takeover. From Friday afternoon insolvency to Monday morning reopening. We will examine how claims are ranked, how losses are assigned, and why uninsured deposits sit where they do. We will meet the architects, regulators, lawmakers, central bankers, who redesigned failure itself after 2008. And we will examine the stress points they worry about most today: commercial real estate, loan maturity walls, regional banks with concentrated exposure, institutions too small to bail out but too interconnected to ignore. This story is not about predicting the next failure. It is about understanding what happens when failure arrives. Because in the modern financial system, collapse does not look like chaos. It looks like procedure. The pre-crisis illusion. For most depositors, banking appears deceptively simple. Money goes in, statements arrive, transfers clear, interest accrues. But beneath that calm surface is leverage. Banks do not store deposits, they transform them. Every deposit becomes the liability on the bank's balance sheet, matched against assets that fluctuate in value: loans, securities, derivatives. When asset values fall faster than liabilities can be met, capital disappears. And when capital is gone, the bank is legally insolvent regardless of how calm the lobby appears. The legal trigger. Under U.S. law, once regulators determine a bank is no longer viable, the FDIC steps in as receiver. This is not optional. It is automatic. The FDIC does not ask permission. It assumes control. Executives are removed. Boards dissolved. Equity wiped out. At that moment, the bank ceases to exist as a private entity. What remains is a balance sheet to be resolved. The claims hierarchy. Resolution is not about saving everyone. It is about following legal order. Losses flow downward. Shareholders are eliminated. Subordinated debt absorbs losses. Senior bondholders take hits. Uninsured depositors become exposed. This hierarchy is not moral. It is contractual. Depositors above insurance limits are unsecured creditors, no different in legal status from bondholders. The bail-in mechanism. When losses exceed capital and debt buffers, regulators face a choice: liquidate or convert. Conversion is cleaner. Uninsured deposits may be partially converted into equity in a new entity, a bridge bank, designed to continue operations without public funding. The depositor becomes an involuntary shareholder. Ownership replaces cash. Why Cyprus still matters. Cyprus proved the concept. Large depositors absorb losses. The system survived. Market stabilized. From a regulatory perspective, it worked. That lesson was not forgotten. FDIC insurance structural limits. FDIC insurance is not unlimited. It is capped by statute. And in a systemic event, timing matters as much as coverage. Insurance protects balances, not liquidity continuity. Who is most exposed? Small businesses with operating cash escrow and settlement accounts, trusts with complex ownership structures. These accounts often exceed limits without redundancy. Commercial real estate, the silent stress. CRE loans mature. Rates reset. Cash flows shrink. Losses surface slowly, then suddenly. Regional banks carry the exposure, and resolution tools are already in place. By the time the public hears that a bank has failed, the most important decisions have already been made. The doors may still open on Monday morning. ATMs may still dispense cash. Account balances may still appear unchanged on screens. The language will be reassuring. The tone will be confident. Officials will say the system worked. And in one sense, they will be right. Because modern banking crises are no longer managed through chaos. They are managed through choreography. What we have examined in this documentary is not a conspiracy, nor a prediction, nor a warning designed to provoke fear. It is a process, one that exists in statute, in regulatory manuals, and in resolution plans written years before any crisis occurs. The FDIC resolution framework was built for one purpose: to ensure that banks can fail without bringing the entire financial system down with them. But that goal comes with trade-offs. And one of those trade-offs is expectation. For most people, money in a bank feels like property. It feels owned. It feels separate from the institution holding it. Legally, it is not. A bank deposit is a claim, a promise. an unsecured liability on a balance sheet that must be honored only if the institution remains solvent. When solvency disappears, the promise changes form. Not because regulators are improvising, but because the rules demand it. This is the central reality of post-2008 financial reform. Failure is no longer avoided at all costs. It is absorbed. Losses are not erased. They are allocated. And the order of allocation matters more than sentiment, fairness, or public understanding. Shareholders lose first. That is expected. Bondholders lose next. That is contractual. But depositors, especially those holding balances above insurance thresholds, occupy a space many never realized they were in. They are not customers in resolution. They are creditors. This distinction is not philosophical. It is mechanical. And once you understand that, the system reveals itself with unsettling clarity. The resolution framework is not designed to ask whether losses should occur. It is designed to decide who absorbs them. And that decision is made long before a crisis begins. What makes this moment in history particularly important is not that bank failures are inevitable. It is that the structure of banking has changed. Regional banks now hold concentrated exposure to commercial real estate at a scale that did not exist in previous cycles. Loan maturities are clustering. Interest rates have reset faster than asset values can adjust. Refinancing windows are narrowing. These are not hypothetical stressors. They are measurable. And regulators know this. That is why resolution planning has become more detailed, more rehearsed, more automatic. Failure is no longer a political emergency. It is an operational scenario. When a bank crosses the line into insolvency, there is no debate about whether it will be resolved. Only how. The weekend timeline matters because it limits public reaction. The bridge bank matters because it preserves continuity. The language matters because confidence is a systemically important asset. And within that controlled environment, claims are restructured, converted, reclassified. What the public experiences as stability is often the result of transformation occurring out of sight. This does not mean that every depositor will lose money. It does not mean that FDIC insurance is meaningless. It does mean that insurance is not omnipotent. Coverage limits exist because the system requires them to exist. Unlimited guarantees would recreate the very bailouts this framework was designed to eliminate. The promise today is not that losses will never occur. The promise is that they will not fall on taxpayers. And if that promise must be kept, losses must fall somewhere else. That is the quiet truth at the heart of modern banking resolution. The Cyprus crisis shocked the world because it made this logic visible. But the lesson regulators took from Cyprus was not that bail-ins were dangerous. It was that they were effective. Order was preserved. Markets stabilized. And the political cost was contained. Since then, resolution regimes across the developed world have converged around the same principle. Internalize losses, preserve function, avoid public rescue. The United States did not reject this idea. It formalized it. And while the mechanics differ, the outcome follows the same logic. Deposits above insured limits are part of the loss-absorbing structure. This is not a judgment. It is a design choice. Understanding this does not require panic. It requires literacy. Financial systems are not moral actors. They do not protect those who believe in them. They operate according to frameworks that reward awareness and punish assumption. The most dangerous position in any system is not exposure, it is misunderstanding. Many small businesses hold operating capital in single accounts not because they are reckless, but because the system never taught them otherwise. Many trusts, escrow accounts, and settlement vehicles exceed insurance limits, not out of excess, but out of necessity. And many individuals assume that staying below a numerical threshold is sufficient protection, without realizing how correlation and systemic stress alter outcomes. This is not about blaming depositors. It is about recognizing that modern finance places responsibility on the informed, not the trusting. The resolution framework does not discriminate emotionally. It discriminates structurally. Large institutions diversify deposits across entities. Governments operate under separate guarantees. Sophisticated actors structure claims with priority and collateral. Others rely on confidence. And confidence is not a legal claim. What we are left with, then, is not a call to withdraw from the banking system, nor an argument that banks are inherently unsafe. Banks are essential. But essential systems require understanding, not faith. The lesson of this documentary is not that deposits will become equity tomorrow. It is that they can legally, procedurally, and without violating a single rule, if the conditions demand it. That possibility alone should change how people think. Not with fear, with clarity. Because the future of banking will not be decided by headlines or reassurances. It will be decided by balance sheets, statutes, and resolution manuals written in plain language that few ever read. The system will not announce when expectations are outdated. It will simply move forward. And those who understand the framework will not be surprised by the outcome. They will recognize it. If this documentary has done its job, it has not told you what to believe. It has shown you how the system works. And once you see the machinery clearly, you never hear the words bank failure the same way again. Because failure no longer means collapse. It means conversion. It means absorption. It means resolution. And in a system built to survive at all costs, the most valuable asset is not money. It is understanding.